Oh man, we have just hit a number that brings us right back to the Great Recession. We have now had just as many months of 7% moves in the S&P 500 as we last had during the bottom of the COVID market, March of 2020, and the bottom of the Great Recession in 2009. That could be a pretty good sign that we've experienced a whole lot of pain so far, and maybe a sign that we could be getting closer to a bottom. Hey everyone, Meet Kevin here. The stock market is potentially about to flip again, and stock capitulation often happens right before elections. But if it doesn't happen, we've got three major reasons, in addition to what I just showed you about these stock moves, that could sustain a very real rally. In this video, we're going to talk about those three reasons. We're going to start with a little look into capitulation around elections. Then we're going to talk about these three reasons the stock market could actually be set for a massive rally. And then I'll show you which sectors are overbought and oversold. So first, let's go ahead and take a look at the capitulation, which is really extended selling or substantially more selling than buying, especially amongst the retail cohort, right around elections. If you've been a subscriber of this channel since the 2020s, you remember, oh, that sounds terrible, since 2020. I don't want to sound that old, since the 2020s. Oh my gosh, it's like we're in 2030. If you've been a subscriber since 2020, you remember I was buying the dip like crazy, right? To the moon rocket launch in March of 2020. That was great, and I never thought we'd see that kind of pricing again, yet on some stocks, we actually are starting to see March of 2020 pricing again. Just look back a couple years, it's scary. But what we also saw was right before the presidential election, we saw a lot of capitulation, a lot of selling, a lot of pressure in the stock market to sell. Take a look at this chart, which shows you that. Not only do we see that sort of capitulation right around the March 2020 era right here, which is this sharp light blue line here, but we also see that right here, the November 2020 elections. I remember in the 2 weeks right before that, thinking to myself, man, what is with all this selling? You know what it is? It's uncertainty about the potential for contested election. Now, this election, midterm election, we're wondering, are we going to get gridlock? Are we going to get more Democratic control? Right now, it looks like we're going to gridlock. And what's fascinating is we still have 1 day left to see some form of capitulation moves here. We did have negative moves last week, but we're not quite in any kind of capitulation spike territory. We're still, according to VandaTrack, seeing positive net buying from retail. So, what three reasons do we have in terms of why stock market performance could actually outperform going forward rather than continue to underperform and bleed out the way it has been? So let's get into those three reasons. Reason number one, stock market performance after the inversion of the 3-month and 10-year Treasury yield curve. This is frequently deemed the last shoe to drop for the Federal Reserve. That is the last inversion that we tend to see in the bond market, is the 3-month 10-year Treasury yield. And while we had an inversion in the 2s and 10s and some of these other things long ago, the 3s and 10s is the most recent and last shoe to drop. You could see that charted right here, where we actually just went negative within the last week. We're barely positive right now, but we went negative, which is great because after the inversion of the yield curve, we tend to see some stock market performance. Take a look at this chart brought to you also by VandaTrack. Look at this. S&P performance following the 3-month, 10-year inversion. First 100 trading days. So right here, you have the inversion point. And what you'll notice on the right is you have returns following the inversion in 81, 06, 68, 19, 00, 78, 73, 89, and 98. You notice the max downside that we got was 3%. And in 3 out of these 9 scenarios, so in 33% of the occasions, we went negative. In 66% of the occasions, we went positive. but look at the magnitude by which on average we went positive. 1%, 2%, 6%, 18%, 24%. So certainly if we took an average here, we'd be somewhere around an 8 to 10% performance. Or if we took a median number, we'd be right around a 6% performance expectation versus the potential downside median of about a 3% performance expectation. So somewhat more bullish. In the first 260 days, so that's the first 100 days after inversion. In the first 260 days, we get a little bit more divergence though, and this really leads to some detail that we have to dive into here. First, without looking at the detail, we get 4 scenarios here. I'm sorry, there's 5 scenarios that are positive and 4 that are negative. And you can see that there are cases where, and it seems to be less likely, or more likely seems to be going positive here, right? 5 out of 9 scenarios, so more likely to go positive. But you do have a couple scenarios that in the next 9 months after the inversion, you actually had more pain. And that was in 68, right before that great inflation period and leaving the gold standard, and in 2000. That was still where you had 2 years to go in the dot-com bubble. Now, a lot of folks are making comparisons to the dot-com bubble now. However, one of the big differences between now and the dot-com bubble is our stock market today has collapsed 3 times faster than the stock market collapsed during the dot-com bubble, leading some to say that the collapse we saw in the 2000s and how that took 3 years could potentially only take 1 year now. Well, folks, the market's been falling since the end of last November, and now we're in November again. 3 times faster, 1 year negative performance. Does it mean we could potentially be at a bottom? It's hopeful, but nothing is certain. So, what is the next indicator that we have? Because we don't just have one indicator the market could be at bottom, we have 3. We're going to talk about that right after I mention StreamYard, one of the most reliable platforms for you to stream video to multi-streaming platforms. Whether you want to create content on Twitch, on YouTube, on Facebook, you want to stream to multiple platforms at the same time and then get an HD download, full HD download of your creation. You want to put overlays up, you want to put comments up, you want to do all of this with Stream. Make sure you go to meetkevin.com/StreamYard. It is what I rely on every single time I go live. I rely on it so heavily that I will put my Federal Reserve days on StreamYard. And when I'm traveling mobile, the ability to share video and audio with different streaming tabs is so critical when I don't have my stream switcher. The browser features of StreamYard basically replace thousands of dollars of equipment for you that I have in the studio. Go check out StreamYard. Go to meetkevin.com/StreamYard. If you do any kind of video creation work where you want to, go check them out. meetkevin.com/StreamYard. So, reason number 2, potential peak Fed funds rate actually being higher than where we think it really will go. Now, this is an interesting argument because if you look at the current Fed curve, markets seem to believe that the Fed is going to hike all the way to about 5.25%. And a lot of this comes because of the Wall Street Journal and good old Nikki leaks talking about how we're going to probably see, or we could see, right? They like to use words like may or could. We could see 5.25 or 5.5 as a terminal Fed funds rate. And this has led markets pretty red last week. Because, we had also pretty hawkish Powell, mostly after somebody suggested that stocks were going up and markets were responding positively, even though they weren't. This is the most stupid suggestion a reporter could have ever made during a Federal Reserve press conference. But anyway, 5.25 is what the market is currently pricing in as sort of a peak Fed funds rate. And this could also end up being flatter, which would be a problem because this here would signal more pain for stocks. And if we get a little bit of a steeper sort of return, we'd have some gains over here for stocks. Now, 5.25 is currently the estimated peak, but that's not actually what VandaTrack is reporting as their potential peak. They actually assess that the peak Fed funds rate could be 4.76%. That's almost a 0.5% lower than the current peak the market is pricing in. And if the market is pricing in higher than reality, then the market's going to have to adjust to a lower rate. What does that mean? Stock market going up. Why could that potentially happen? Well, two potential reasons. Number one is the fact that we're seeing actual observed rents decline significantly faster than what the Bureau of Labor Statistics is showing in their CPI report. Remember, we get a CPI report this week. We get that on Thursday at 5:30 a.m. I'll be streaming it live. And while we don't yet expect the BLS to show any kind of peak in shelter inflation, we know it's coming, which is optimistic, and even the Fed knows it's coming. They're just waiting for this inflection to happen. For the CPI this week, I'm actually relatively optimistic. We're expecting 0.6 on the month over month, which actually, in my opinion, is great because it's relatively high. Last month, we had a 0.4, and anytime we get a high estimate, it's really easy to come in under it. What's bad is when we have estimates like, oh, it's going to be 0, and then it comes in at like 0.1 on the month over month, right? That's bad. But anyway, we'll see what happens with CPI. But this is one of the reasons they give is the inflection point in rents. But the second reason that we should think about, I've gathered this from other sources, but it's also, I think, very valid, is that payroll growth is set to be at 0% by the second quarter of 2023. That's really going to help drive pressure down on the Fed to keep hiking. So maybe Vanda Track will be correct on this. But we also have a third potential reason to be happy, folks. And then we're going to talk about the oversold and overbought sectors. And folks, it is the potential for a rally post-election. Remember, this red here is post-election. And usually in the about 50 days that are left in the year after an election, about 52 days after the election, we tend to actually see kind of nominal, slightly positive performance. But it's in that next calendar year, starting in January, that we really get some beautiful average long-term returns. Take a look at the chart here. If we get split House and Senate or any form of gridlock, we're expecting between 1.4 to 2.9% returns on average by the end of the year. And if we look at next year, we're looking at potentially as much as 18.7 to 19% rally mode, baby. So very, very bullish signs here. Where are the overbought and oversold? Here you go, folks. If we compare sectors to the 2-year real rates, to screen out what is out of sync with the Federal Reserve's hiking cycle, what do we see? We see sell signals at energy, nickel, the dollar, Italian and Brazilian equities, and silver. Here you go, divergence of anywhere between here 7 to 15%. And where do we see buys? Well, potentially Taiwanese equity, cotton, technology stocks, discretionary, U.S. consumer services, and coffee, baby. Buy signals across the board here, also anywhere between 5, 6 to 17%. So, if you want to get some of the best data every single day, what do? You hit that subscribe button and come back to this channel multiple times a day as I try to post as much as possible. Remember, we're also now hiring paid interns. Go learn more by going to meetkevin.com/jobs. 2023 is going to be a phenomenal year, and our rocket ship has got some room on it. And we'd love to have you aboard. Thanks so much, and we'll see you in the next one. That's meetkevin.com/jobs, and check out our sponsor, meetkevin.com/StreamYard.